Let's start with the concept of holding period return. Holding period return is the return earned from investing in an asset over a specified period of time. This is the holding period. It could be 3 months, 6 months. Essentially, it is the period for which you are holding on to an investment. The formula for the holding period return is quite straightforward. I will explain this through an example. Let's say that you buy a stock for $50 and at the end of the holding period, the stock price is 58 plus you receive a dividend of 2. The holding period return then is DH, which stands for the dividend received over the holding period, which is 2, plus the price of the stock at the end of the holding period, which is 58 in our example, divided by P naught, that's the original price of the stock, minus 1. When you do the calculation, you will have 60 over 50 minus 1, that is 0.2 or 20%. Another way to look at this formula is shown right here, where we can say that the holding period return is the dividend yield, which is in our example 2 over 50, plus the capital gain, which is 58 minus 50 over 50. So this would be 8 over 50, and this will also give us 20%. If the dividend and the holding period price are realized, then we call R the realized return. And this is fairly straightforward. Let's say that you are sitting here at this point in time, say this is 30th June, and you made your investment on 1st January. This is the holding period. You made the investment here on 1st January and then you sold your stock for 58 here, plus you got your $2 dividend. Then the return of 20% would be called a realized return. On the other hand, if you are sitting here at time 0 and over the next 6 months, which is your next holding period, you expect a certain dividend called DH and you expect a certain capital gain, then the yield that you expect over this holding period will be referred to as the expected holding period return. Coming now to the concept of required return. The required return is the minimum level of expected return that an investor requires given the asset's riskiness. The required return represents the opportunity cost for investing in the asset, i.e., the highest level of expected return available elsewhere from investments of similar risk. If the expected return for a given investment is greater than the required return, then we say that the asset is undervalued. Take a simple example where, based on your calculations and expectations, over a given holding period, the expected return is 12%, but the required return is 10%, then we say that the asset is undervalued. On the other hand, if the expected return is 8% versus a required return of 10%, then the asset is overvalued. If the expected return and the required return are the same, then we say that the asset is fairly valued. In an efficient market, the expected return and the required return will be the same. The expected or ex ante alpha is the expected return minus the required return. And clearly this is a looking forward number. In other words, you are here at time 0 and over a given holding period, let's say that you are expecting a return of 12%. The required return for assets of similar risk over this period is 10%. Then we can say that our expected alpha is 2%. The realized or the expected ex post alpha is the actual holding period return minus the contemporaneous required return. Let's say that over this period, the actual return, now you have moved forward in time, so you are at this point, and the return that you actually realized was 8%. During this same time, the contemporaneous required return was 5%. So the question is, what do we mean by contemporaneous required return? This is an important term that keeps showing up in questions. The contemporaneous return is the return on other investments with similar risk during the same period. So if you invested in a particular kind of stock, you look at the return on other similar stocks, similar risk over the same time period, and this return, let's say, is 5%. And remember, this would be a realized return associated with similar stocks. The realized ex post alpha then is 8% minus 5%, which is 3%. And when investment managers are measured, when we look at their performance, we look at the realized or ex post alpha. So this is a measure of the manager's investment skill. Expected returns from intrinsic value estimates. Let's say that a stock is undervalued, and here we will connect with material from a previous reading. Let's say you have a situation where the market price of a given stock is 60 and you believe that the intrinsic value is 70. Now, you plan to hold the stock for a year. What are the different scenarios? One scenario is that this mispricing increases. In other words, you continue to believe that the value is 70, but the stock price falls. So the market price actually goes down. So this mispricing will actually increase. Another scenario is that over your holding period, the mispricing stays the same. Third scenario is that the mispricing may partially correct. So here the mispricing is 10, maybe the mispricing goes down to 4. Mispricing may be corrected completely. In other words, this mispricing of 10 goes away, which will be good for you if you actually purchased the stock at 60. And finally, the mispricing may overcorrect. When you buy an underpriced stock, then your expected rate of return has two components. One component is the required return, and this will be calculated typically based on a model such as CAPM, where the return will be based on the risk characteristics of the investment. The other component of return is based on convergence, and convergence here refers to the convergence between the market price and the intrinsic value. In other words, over time, the market price will hopefully converge to what the intrinsic value should be, plus there will be the required return. So in other words, the expected return is RT, where RT is the required return given the level of risk, plus this expression which refers to the convergence between the value and the market price. Coming now to the discount rate and the IRR. The discount rate is a general term for any rate used in finding the present value of a future cash flow. Generally, the discount rate depends on the characteristics of the investment rather than on the characteristics of the purchaser. In other words, if the investment is risky, then we use a relatively high discount rate. If the investment is less risky, then we use a low discount rate. The IRR is the discount rate that equates the present value of the asset's future cash flows to the asset's price. You have learnt about IRR at level 1 in equity, in corporate finance, and in quant. But here's a quick refresher. If you invest 100 at time 0 and at the end of 1 year, let's say you recoup 120, then the IRR, which is the return on this project, is 20%. And you can notice that if you find the NPV of this project, you have minus 100 plus 120 over 1 plus R. And if you set this equal to 0, then the rate which makes this equation true, in other words, the rate which makes NPV equal to 0 is 20%. So the IRR is effectively the return on the project. If an asset is correctly valued, in other words, the market price is equal to intrinsic value, then the IRR or the return will be equal to the required return. If we use the simple Gordon growth model, then the value of a stock or the intrinsic value is the year ahead dividend divided by R minus G. And I'm sure you remember this. Let's say this is the intrinsic value, which is equal to the price of a stock in an efficient market. This is equal to D1 divided by R, which is the required return, minus the growth rate. This is the sustainable long-term growth rate. You can do a little bit of algebra and show that R is equal to D1 over the market price, which is P. And notice that in an efficient market, the V and the P are the same, plus the expected dividend growth rate. And this is the key point, which is that in an efficient market, the required return and IRR are the same.